So you'll continue to see pressure to see gold go higher and higher price, and really it's not. Gold's a constant. It's announced everywhere in the universe. The math never changes. What changes is the amount of dollars printed against it. So it's the dollar depreciation measured in terms of gold that gives you a higher price. And that trend has not ended, and it's probably not going to end. So the gold response will be higher and higher. You don't buy gold for a reaction. You buy gold for a response. And the response of, let's say, people in India, people in Asia, a lot of Europeans, even South Americans, is that all these currencies die and go to heaven. And the only way my family did better while that took place was to own some precious metals.
DavidMorgan, a prominent analyst, suggests that the ongoing trend of higher gold prices is likely to continue, primarily due to the ongoing depreciation of the US dollar. He anticipates that this upward pressure on gold prices will persist rather than reverse. Recent developments have supported this view, with gold climbing to $2,016.30. This surge was partly driven by U.S. inflation exceeding forecasts, indicating a continuation of the price pressure on gold. The diminished likelihood of immediate Fed rate cuts has also contributed to gold's allure, as the U.S. dollar has weakened since last Tuesday. Moreover, traders seeking protection have increasingly turned to gold, particularly following the latest inflation reports. Despite a stronger dollar and elevated Treasury yields, gold prices have remained steady, highlighting the metal's resilience in these market dynamics. Morgan further emphasizes that gold doesn't necessarily react strongly to interest rates unless they significantly impact real rates of return, which are compared to actual inflation rates rather than official measures. Regarding prospects, Akash Doshi, Citi's North America head of commodities research, suggests that gold could surge by around 50%, primarily in case central banks sharply ramp up purchases of the yellow metal. This scenario could occur amidst stagflation or a deep global recession, where gold is typically seen as a haven. Notably, the Fed benchmark interest rate has remained between 5.25% and 5.5% since July 2023, marking the highest levels since January 2001. However, markets anticipate Fed rate cuts, possibly in May or June. This expectation and growing economic uncertainty have propelled gold's status as a safe haven. Morgan also touches upon the psychological aspect of gold investing, highlighting that many individuals across various regions view gold as a hedge against currency devaluation. This perception further bolsters gold's appeal as a reliable investment option. Join us as we delve into insights shared by David Morgan. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
I think I'll continue to see this, what I call knee-jerk reaction. As you outlined, Kai, I mean, you get this big blip, you get this number, everything reacts, but there's a difference between reaction and a response. A response is where you basically see the situation for what it is, you analyze it properly, you use discernment, and then you do something or don't do something. And the response of the gold market is much more important than the reactions. So the response to the gold market and interest rates is the gold really doesn't care about interest rates until they're meaningful. Now I know 5% as it was a few months back on some of the money markets, close to that, was significant, and it is relative to zero. But nonetheless, it's not really above the true inflation rate. When I say true inflation rate, I mean as measured by the 1980 paradigm, and it's outlined at shadowstats.com, John Williams' site. And in that case, the true inflation rate is probably closer to 9 or 10%. So until you get a real rate of return, interest rates don't really mean that much. That's the response of gold, not the reaction of gold. So you'll continue to see pressure to see gold go higher and higher in price. And really, it's not. Gold's a constant. It's announced everywhere in the universe. The math never changes. What changes is the amount of dollars printed against it. So it's the dollar depreciation measured in terms of gold that gives you a higher price. And that trend has not ended. And it's probably not going to end. So the gold response will be higher and higher. The reactions will be, let's make sure that we can control the psychology of a new participant in the gold market, a potential participant in the gold market, or maybe some people that are break even or underwater. Let's see if we can scare them out. But as far as what the meaning is, I think those two words are something worth reflecting on to get a better picture of how you view the gold market. You don't buy gold for a reaction, you buy gold for a response. And the response of, let's say, people in India, people in Asia, a lot of Europeans, even South Americans, is that all these currencies die and go to heaven. And the only way my family did better while that took place was to own some precious metals. And that's a response. That's not a reaction. That's ingrained basically into their consciousness. And none of them had to listen to you or I to know that. I am not as big a gold bug as I probably appear to, thousands of people that have tuned in over the years. What I don't like about gold is it's controlled by the bankers basically. Now, half the gold, roughly it's a 50-50 split. Roughly central banks have about half the gold and population at large has about the other half. But there's a real problem with the gold only standard. I put it up my Twitter feed recently, and everyone that's really wants to be a student of markets, a student of money, should look at this article, not written by me. It's called Gold Standard Equals Fiat in Disguise. And the argument is that he who owns the gold makes the rules. And when you own the gold and it's a monometallic standard, you can bend those rules or change those rules to go from 100% gold backing to 40% gold backing to international trade only, like Nixon did in 1971. He didn't outlaw gold for international trade. He just made it illegal for Americans to own it. And then, of course, he didn't settle in gold to internationally. So I want to be clear on that. But the point is that you always morph into a paper only standard. And then, well, that's okay because I say so, and currencies could float against each other. There's no standard, and on it goes, which goes to monetary destruction. So, gold standard alone, the point is not necessarily a means to control an out of mind governmental money supply. You really need a bimetallic or trimetallic standard.
The current gold to silver ratio stands at 88.959, higher than the historical average. This ratio was recorded in December at 81 to 1, far exceeding the modern average range of 40 to 1 and 60 to 1. Since then, it has risen another 5 to 10 points, standing above 90 to 1. DavidMorgan attributes the change in the gold-silver ratio to the rise of industrial uses for silver, particularly with the growth of electricity and scientific advancements. The increased demand for silver as an industrial metal has contributed to a lower ratio than historical standards. During Monday's session, silver showed some negativity, but it's worth noting that the session coincided with President's Day in the U.S. Silver slightly retreated from the crucial $23.50 level, encountering resistance several times. Morgan acknowledges that the current price of silver primarily reflects its role as an industrial metal rather than a monetary reserve held by central banks. He suggests that if silver were to regain its status as a primary monetary metal, its price could see significant changes. Let's get back to the interview.
First, is there enough silver? And the answer is no. And here's why. If you go back and you start looking at a chart of the gold silver ratio back from about 1000 AD till present day, uh, silver never got above 20 to 1 until the last 130 years or so. So it's stuck around the natural ratio, which right now is 7 to 1, used to be 12 to 1. And the edict mandated monetary ratio was 16 to 1, roughly. So it stayed in that range for hundreds and hundreds, for thousands of years. And why was that? And it took me a while to think of it. I'm not as smart as I think I am sometimes. I'm trying to be funny here, a little self-effication, but uh, because they're both money. Silver and gold were money, and that's all they were. It wasn't until the late 1800s, 1900s, the beginning of the age of oil, where we started having all this scientific breakthroughs and the electrification of the world, where silver is a key component in an industrial metal. So, if silver were traded as a monetary asset only and not as an industrial metal, and used by the central banks as a monetary reserve, the price of silver could be equal to the price of gold because they're equal in amounts above ground in investment form. I'm not making a case that that's the actual price or should be. I'm just saying since it's being demonetized, it trades as if it's an industrial metal only. But if we did make it a monetary metal, let's look at what it's worth. Then you ask me, is it an industrial metal or is it a monetary? It's still both. There's transactions made in silver for a monetary reason, but officially it's not. So economically, yes. Philosophically, no. It's not in the money supply. It's not considered money by any bank anywhere in the world. It's only the people's money and people that transact with it for monetary purposes, which is a very, very small subset. But it doesn't mean it couldn't reemerge, especially in the digital age where you can use an asset backed digital currency and use silver as a backing to a crypto sometime. So there's a possibility that it's taking place, but whether it will gain traction or not, we'll have to wait and see.
Silver tends to show more volatility than gold, presenting an opportunity for short-term gains and potentially leading to a rally in silver stocks in 2024. Silver's lower price than gold makes it more accessible for retail investors, which could result in a broader investor base and increased liquidity in silver stocks. The white metal's performance is bolstered by its heavy industrial usage, with applications in solar panels, electronics, water purification systems, automobiles, and other products. With silver exhibiting higher volatility and its potential for short-term gains, do you anticipate a surge in silver stocks in 2024, especially given its affordability and heavy industrial usage? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.